Is that going to continue here, Anurag?
So, I would say, as far as their debt offering is gone, I mean, they've done that and that's fine. But they also have another equity offering that they have to do as part of their full year plan. But that's the big question as to what price they're going to do it now, because, in the last, you would say, few days, the market's been actually going southwards. So I would have said that, they probably had a better window to boost that, share equity raise, let's say a couple of weeks ago. But if the political, climate improves and we see a rebound in AI infrastructure stocks, then, Oracle will go out and issue those shares.
How will stocks like this be affected by the SpaceX IPO and the other massive, OpenAI and Anthropic coming after it? Because it looks like investors are freeing up cash, selling off Bitcoin, selling off gold, selling out of their tech winners in order to put money aside for these IPOs.
Yeah, it's actually a very good question on that end, and we will see how that shapes up. But when you look at that bucket of Anthropic and OpenAI, Oracle, CoreWeave are still in that bucket because it's part of the same AI infrastructure trade. I think the bigger damage that could happen to some of them is if rates keep on rising, because that really has an impact both on funding cost as well as the valuation of these high growth names. So there's a dual edge over there for the AI players.
What kind of valuations do you expect to see on OpenAI and Anthropic? I imagine they'll both be trillion-dollar plus IPOs, right? So are they going to be 50 times sales, 75 times sales when they go public?
Well, that's, I think, the biggest question at this point, because they already have a private, company valuation close to $1 trillion. The big question is, do the market still looks at only growth rate, or they're going to go start looking at free cash flow? Because we have seen that in the past that, when people are very excited, they only want to look at sales growth. But you see the first hint of a slowdown, then everybody start running and start looking at free cash flow. Look at Figma's IPO. When they came out, everybody was so excited. In the last, I think, 12 months or so, stocks down 80% at this point, because now everybody's focused on stock-based compensation and margins and what could happen with Claude. So there's a fair amount of uncertainty when some of these startups go public.
All right, Anurag, thanks so much for joining us. Bloomberg Intelligence senior analyst Anurag Rana talking about Oracle earnings coming up after the close. And also coming up after this break, private market titans sit down with Danny Berger. She joins us live from Super Return in Berlin with the latest next. This is Bloomberg Open Interest.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersetchi in El Ola, Saudi Arabia, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Tech. Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Companies are performing just fine, but doesn't mean you aren't going to see some accidents along the way. When things grow this fast, typically some things break. There'll be some losers along the way, and at some point in the next 2, 3, 4 years, there'll likely be some kind of shakeout.
The industry lost its way a little bit. I've been pretty vocal on that. The industry was founded on finding good assets, pay a reasonable price for it, operate it better. When interest rates went to zero and stayed there for a decade, the equation changed to find a good asset, don't screw it up.
In private equity, the environment is pretty stuck right now. If you're going to buy a technology company or a software company, a solution provider to the enterprise, now you really want to see that they're making a lot of progress around their AI offerings.
There are entire sectors, Danny, like private equity, like real estate, which are constipated, right? They can't sell. I think on balance, it's also fair to say, my God, there are lots of the canaries in the coal mines are telling you a bunch of stuff.
Those were just some of the power players speaking with Danny Berger at Super Return, Europe's largest private equity conference. Danny joins us now from Berlin. Isn't that the biggest private equity conference in the world? I mean, what's bigger than that?
I don't know. I mean, I guess Milken and Davos have a lot of private equity people at them, but this has got to be the biggest, like, pure private equity. And I got to say, I was just listening back to those interviews and the people around here. There's a real sense of anxiety in this industry. I mean, you heard from the speakers there that things aren't clearing. Victor Kosla used the word constipated, which I guess is quite evocative. But I mean, people are here. The mood is still good. There's not any less attendees here. So even though there's this idea that things need to be worked through, there still is just this underbelly of optimism. And I guess at the end of the day, these are deal people, and they are here to get deals done. So they kind of have to be optimistic to some degree.
Is it super returns that investors are seeing from this sector right now, Danny?
Are you saying, are there super returns that they're seeing?
Yes.
I mean, I think there's this idea that on paper things look good. And the things that have been sold, those have looked good too. But what about everything else that has just been backed up? So basically all the IPOs, of course, we talked to Liftoff last week, the CEO. That was huge returns for Blackstone. We're going to sit down with Martin Brand in just moments about that. I spoke with General Atlantic, who was also part of that deal. So private equity things that are IPOing, that are exiting, they're really strong, but these are the best assets. There's this kind of other class. It's these middle returns, these middle managers who maybe have smaller assets that are struggling to find a home for them, that they're not finding buyers. That may be seeing less returns. Private credit, too, just given the rate environment, mathematically has lower returns as well. And you're seeing that with an impact for the LPs. The LPs, I've been talking to manager after manager, they're sitting down with these managers and saying, listen, we want to consolidate. We don't want platforms. We're not going to be giving as many people as much money. We have money to spend, but it's going to be with less people. So you're really feeling the ramifications, and it's another year where people are saying consolidation and marriages of convenience, of inconvenience. It's going to be happening at pace.
What are you hearing, speaking of private credit, about redemption requests, and how much has that spread over to private equity?
They love to say nothing to see here, that it's being worked out. I think there is a feeling that redemptions will stay elevated, but it's the refrain, Matt, you and I have heard so often, that it's a small part of the industry. Even though it's a small part, though, it is dominating the sentiment. On one hand, you have LPs asking serious questions about what's going on, what impact that has. But in the same vein, people who aren't facing those kinds of redemptions, that don't have the wealth product, we spoke to Sixth Street about this, as well as Ken Kinsella of Churchill. It's kind of a great time because people have been pulling back. Process for private credit are less competitive because all of these BDC players aren't present in the market right now. They're kind of being iced out. So for those who can still compete, it's been a really, really good environment. But still, there's a lot of explaining to do. I spoke with Blair Jacobson of Ares, who said that the panic among retail investors, it's just psychological. It's not returns itself. So it's still an industry that is trying to explain itself and say, hey, the fears you have, they're not real. Look at the performance. It's still okay.
We are seeing big IPOs. There were IPOs ringing the bell at the NYSE, IPO ringing the bell at the NASDAQ. Obviously, the biggest IPO in history happens this year, and it'll be followed by two other of the biggest IPOs in history. Exits seem healthy right now.